Please welcome the panel on Common Sense from Uncommon Investors, moderated by Michael Milken, chairman of the Milken Institute.
It's May 5th, 2025, and we are lucky this afternoon we have 5 of the world's greatest investors on one stage and an okay moderator here. So we're going to start with Ann. The world has experienced a fundamental shift in the geopolitical landscape, with the U.S. recently upending global trade. What are investors to do to respond to these shifts, Ann? And how is Guggenheim approaching this?
So we find ourselves at a very interesting time in history. We're in a bit of a paradigm shift. For those of you who heard Treasury Secretary Bessent's comments this morning, I think he framed what the administration's goals are really well. He mentioned 3 what I call pillars of the administration: taxes, deregulation, and trade policy. I would add a 4th one, which is also immigration, or the change to the U.S. immigration policy. And what we're seeing is the rise of fiscal policy driving so much of what we are observing in the markets. We were priced to perfection in equities coming into this year, and of course, when you have a world where there's a lot of what I call gray swans flying around, you're at risk of a correction, which is what we saw. The market focused on one of those pillars to the extent of, and to the exclusion of the others. And I think that moved the markets a lot. This created a huge amount of concern and insecurity among investors. I tell investors to look past this volatility, to think about where we are historically. And in terms of volatility, you can see on this chart, we've been in a world in the last several years of enhanced and elevated volatility, particularly in fixed income, but we've also been in a trading range. And if we look at a chart that you showed earlier today, Mike, when you were speaking to the Treasury Secretary, with regard to there are long timelines over the Treasury market where you end up in a trading range. And we find ourselves in one right now where we're moving within, we'll call it the mid-3s to mid-4s in the US on Treasuries, on the 10-year. And this is a time when you have to think about other ways to act as investors. Take the long view and look forward as we go through this paradigm shift in fiscal policy, potentially in Fed policy, and I know I'm going to hear from all of our co-panelists today also with regard to ways to maneuver within this investment paradigm shift. If the administration is able to do what they need to do and want to do, this will be very, very important in terms of global restabilization or realignment in a new and different way. So look through to the opportunities that exist regardless of those particular larger macro and, dare I say, geopolitical and fiscal policy paradigms that we're seeing.
Thanks, Ann. Jonathan, public markets are increasingly driven by macro volatility, passive flows, short-term earnings pressure. Are the private markets, in your opinion, more relevant as an engine of long-term creation of value today?
Yes.
Okay.
So, Mike, thanks for having me again. It's a reflective time for me. 40 years ago this year, I moved to Los Angeles, California, to join Mike and Drexel Burnham on the high yield, the birth of really the high yield bond industry and the birth of the private equity industry, which was called the leveraged buyout industry. So it's a bit of a reflective time, and as I look back over 40 years, you know, we've been through every imaginable crisis and market dislocation, and it looks like we're going into another one of some type, the depth or duration of which to be determined. And when we do that, you know, in private equity, we can afford to take a longer-term view. Our first job is to protect the assets we have in the ground for our investors, and the second is to hopefully turn the crisis into an opportunity for investing new capital. But if you look at our industry, private equity, you know, it's a $5 trillion industry at this point, so it's
I love
giant.
the way you prepared a slide showing your sandbox, Jonathan, versus the
Should
whole.
we put the sandbox up, or?
Yeah, I'm sure they'll find a way.
Okay. In any event, you know, we have a giant industry. I call it the $5 trillion sandbox. Bain has said it's $5 trillion. So we can afford to take a longer view. But we have found, you know, for example, the public equity markets were a major source of exits for us. They're somewhere between unreliable, dysfunctional, and broken. So we have to do self-help and find a way to do our own thing. And in our industry, the challenge today is not investing, it's not growing our businesses, it's getting out of our businesses. So, but we live and work in a very creative and inventive industry who are coming up with lots of different ways for us to do that. So, you know, we're not worried as much about will we be in a technical recession later this year. We kind of think we will be, but it doesn't inform our decisions that much. We just have to make sure our companies can get through the storm and continue to grow them. Hopefully good companies gain share in difficult times and prepare for better times. So, you know, none of us, again, imagined private equity. We have tens of thousands of companies, tens of millions of employees. We're a huge part of the GDP and growing. So we're a giant, I think, force for good in American business, struggling a little bit with some of the existing tools in the capital markets toolkit to make the whole flywheel work. And we're working lots of different ways to be creative there to help it work better.
Thank you, Jonathan. Robert, I think it was around 25 years ago you started Vista.
Correct.
With an exclusive laser focus, when I first met you, interest on enterprise software investing. What was your theory about enterprise software then, and how has it played out over the last 25 years? And what is next for that sector?
And thanks again, Mike, for inviting me. It's always a pleasure to be here and with this distinguished and wonderful panel. 25 years ago, it became very clear that enterprise software was going to be the most productive tool introduced in our business economy over the last now 50 years. What has changed is it has a new bedfellow. That bedfellow is now a tool, this generative AI, that is now actually the most transformative technology of our generation. And there's quite a bit of debate as to where does this all lead? Is it disruptive to enterprise software? Will it eat enterprise software? Well, the answer is there will be a certain number of these businesses, enterprise software companies, that are going to be fed by artificial intelligence. They will become agentic. And we measure today the productivity of our 89 software companies' products to their customers. It's still over a 625% ROI. Agentic solutions increase that ROI by orders of magnitude in its capability. That's point one. Point two, the effect of operating businesses utilizing Gen AI, we can now transform our businesses from rule of 40 to rule of 70, rule of 80. And so there's a new paradigm that will exist in the world of enterprise software. Certain companies will become agentic. Certain companies will become what we call AI-enabled, massive margin expansion. And there will be companies that don't have a right to exist. And so the key now in our world, as as a software investor, is to understand how to build capability to determine which ones you can make agentic, which ones you can operate as an AI-enabled, and which ones you need to avoid. That's a dynamic we're investing in day to day. In the early phases of transforming businesses from on-prem The first 15 years to cloud, we built a factory. That factory converted more businesses, as from my count, from on-prem to cloud of any other institution on the planet. We have now built a factory to take it from cloud to agentic. And pushing the assets that we're entrusted with today, which is our principal responsibility, through that process and determining where they are going to lie is part of our next task. And so building that factory, enabling that with the right sort of partners and capabilities enables a massive economic uplift opportunity that Gen AI will uniquely enable for enterprise software companies. That's the world we live in today.
Robert, what are the skill sets needed today, and how do they compare to 25 years ago?
So there's different levels. As an investor, you have to actually understand the capabilities of these tools, which means you have to experiment with multiple tools in multiple environments. I like to look at Vista and say we have 89 software companies, which means we have 89 laboratories of which we can test different tools and capabilities, and having the right sort of strategic partners on the technical side to see which ones work in what instance, and then, like I say, copy and paste the ones that work effectively across the patterns. Pattern recognition continues to be key. Also, curiosity and understanding what the implications are of these tools, not only in the business that you're in, but the customers that those businesses are serving. That's an important part of it. And you have to think about it from a global perspective, because not all the tools are being developed in one place any longer. And ensuring that we have that sort of global coverage through the right sort of partnerships, I think, is essential to building out capabilities at scale.
Thank you. Mark, you're one of the fastest growing money management firms maybe in history today. And as we think about the recent turbulence in market, people changing, institutions are worried about their portfolios. What role can alternative investments play in a time like this?
The alternative investment industry, I think, thrives exactly in this time, and none of this can be done, I don't think, well without first thanking you, Mike, both for the opportunity to be here, but also creating all that has followed. This industry, private equity and now private credit, and all the alternatives spawn from your brilliance, for lack of better terms. So thank you for doing that. It is an incredible.
It's my gift to all of you.
All right, thank you.
Much appreciated. Look, at the end of the day, being able to look through the noise and being able to provide capital that isn't predicated on the emotion or mood of the moment. Ann started us off with this. It's an opportunity to think about assets that are, perhaps non-traditional and look through the volatility, is exactly why we all exist. And frankly, it's why we can produce any kind of incremental returns. And fortunately, people up on this stage have produced incredible returns for their investors by being able to see through the short term and invest for the long term. And that's what we've done. And frankly, if the heart of our business over the last 10 years, we've been really lucky to grow the way we have, but it's largely been by keeping a very close eye on a couple of basic tenets, which is, look, let's produce a set of investment results, because it's the most important thing we do, for our investors that are about downside protection, income orientation, inflation protection. So really provide that base load, base element of a portfolio, and do that by going and offering corporate users long-dated partner-like solutions. I'm very lucky to be a partner of Robert's, for example, and in this world of AI, generative AI, people that are lucky enough to invest with Robert are going to thrive. Most people are going to find themselves out on the bleeding edge, and they're going to end up probably with a pile of ashes. But there's ways to invest, for example, in all the infrastructure that supports the transformation Robert is talking about, right? To build the hyperscale data centers. If we didn't have the private market, I don't think we'd have a way of meeting the $1 trillion capital need to build the infrastructure that will support this incredible revolution. So I think today is actually a really good day to be sitting here having this conversation. It doesn't mean it's always fun to be in a volatile market, but the volatile market is what creates the opportunity for returns and the opportunity for alternative assets to serve a role in the economy.
So Victor, I called you about a week ago, surprised you on a Saturday, and I was thinking, boy, this environment really plays into your strengths as a firm. And I was thinking, what are the investments I have that I can see if your firm wants to get involved? But the ability to build businesses. So You can make a lot of loans, but if 10 of them, 20 of them start not going well, you need someone to help build those companies. Talk a little bit about the history of the firm, where you are now, and how are you staffed today at the firm? Where have the people that work for you come from?
Mike, that was such an energizing phone call for me on a Saturday. My secretary says, Mike wants to speak to you. And she doesn't have to say Mike Milken. It was like, Mike wants to speak to you, and I was in a grocery store talking to him. We started out...
And I was looking at my portfolio and being worried.
No. We started out, the roots of our firm are in distressed debt and restructurings. This is 2001. And then, as time has kind of gone on as a firm, our view in 2007, 2008 was, yeah, it's a great business, but it's a super cyclical business. It's a 2-year out of 10-year business. So we started to take control of companies and try and improve them, try and operate them, and I dare say, hopefully, reasonable number of times transform them. And we built, and then over a period of time, we started to go not just in the corporate world, but in real assets. So whether it is power plants and toll roads and ports, we expanded into that, all the while keeping our operating skills. And we, from the outset, were a US-Europe firm. And I don't need to tell you, Europe has been the gift. Please, I don't want to offend any Europeans here, but every 2-3 years there's a crisis. So we built a firm over the last 24 years where we can take advantage of the distressed debt cycle 2 years out of 10, but we can invest quite consistently.
So we have a number of people like myself that might want to apply for a job. What are you looking for in talent at the firm today?
So we've got about 100 or so investment professionals, and 20 of them are operating partners. So these are people who work with the investment team. They build a value creation plan. You know, the businesses we are involved in have often been undermanaged the last 3-4 years. As a company gets into trouble, that company management starts to spin in and out, and it kind of loses its way. So for us, 8 out of 10 times, we end up kind of making dramatic transformations in the management team. We build a new value creation plan with the operating team to drive it. And by the way, and I'm really proud of this, when you look at organic EBITDA growth in our portfolio of companies, in our holding periods, it's over 100%. It's not like every company, but on average, it's 100%. The other thing, Mike, we look for in our team, sure, we've got the hopefully smart investment professionals, is sourcing is a really big piece of the pie for us. When you buy debt as a way to take control, that debt market is it's illiquid. It's a little bit of a black box. A bank or an asset manager doesn't want to advertise, I've got problems. So how you source and originate it, we don't, we love Goldman, but my God, they're really good. When it's really good, cheap, they buy the debt. So we've set up a business where we can go and also talk to asset managers directly and buy the debt. And we've got 15 people doing it. So unlike just a classic investment operation, you see a firm with the team we has sourcing in it, it has operations in it, all welded together.
So Ann, you have always had a steady hand, but not every investor or every client has a steady hand. And I know one of the things you've really focused on is looking at systemic issues over the years. If we step back and think about what systemic vulnerabilities might we see in the current environment and what might trigger that instability?
Well, before I answer that, I would like to say that I would hope that everybody that we hire at Guggenheim has the level of intellectual curiosity, Mike, that you have, to your question about the type of person that we want to hire. And I would also like to say that if we took what you really do well and harness it, one of the elements is to separate signal from noise. And right now we have a lot of noise. And that happens when we get mired in moments of market turmoil and uncertainty. But we do have some very significant, both systemic positives, but also some systemic risks, particularly in the US. And the sheer magnitude of the fiscal debt situation in the US is troubling. With the rise of modern monetary theory and the belief that you never have to pay debt back, I think that lent itself to being allowing the U.S. fiscal spending situation to become quite out of hand. And you can see on this chart that it's more significant than it's been in any kind of recorded time back again, 200 years, and as a percentage of GDP, and it's projected to go higher. And I think this is one of the elements that Treasury Secretary Bessent is addressing or hoping to address, but he needs Congress and he needs some budget hawks to help him. This is an area of concern because the cost of that debt, the interest cost of that debt, is crowding out other expenditures within the government. And of course, it's giving rise to a burden to the Treasury market and who are going to be the purchasers of those treasuries in the U.S. The interesting thing is at the same time that we have this rise of the governmental spending, what we see is actually a transference, if you will. We've seen a transference to some great extent of private debt into the public sector. And that occurred post-COVID as a result of the amount of fiscal budget stimulus that was happening. The good news is that as we're here at this particular part of the cycle, balance sheets in corporate America are pretty good for those issuers that are issuing in the markets where we invest. Small businesses, I would say, are in a different situation. They're more, at this point in time, they're more in a struggling situation, but relative to the investments that we're making and the opportunity set to deploy capital, that is one of the opportunities. Additionally, there are some mega trends that are happening right now in the world. Robert, of course, talking about artificial intelligence, technology build-out, the need for infrastructure investment. These are strong positives because growth is going to continue to happen in the U.S., but also outside the U.S. And I think the U.S. will continue to attract capital going forward, and but does have to recognize that we are potentially in a very significantly unstable fiscal story. But you can see here with the move towards continued reshoring that started post-COVID and is continuing to this day, and the demand for power, artificial intelligence, technology, communications, logistics, and manufacturing build-out is going to be giving us an opportunity for a tremendous amount of investment.
Thank you. And Jonathan, increasingly over the years, you have focused on trying to let the employees of all the companies you own know that they're partners. In the last year, you had a significant realization in SRS. As you look at motivating your management teams and the employees that work for the companies, what are some of the tools you've used increasingly in recent years, and maybe give us a few examples?
Sure. Look, at our industry started out called the management buyout industry. We would partner with management teams that can be 5, 10, 20 people. You know, over the past 30 plus years, we've evolved that to a much broader degree of employee ownership. And that's become very topical today in stakeholder capitalism. But we've been doing it for 30 years, and we do it because it's good investing. It makes us more money, it makes our investors more money. But at the same time, it brings often thousands of employees into a shareholder base who are relatively unsophisticated. And when you have an exit, it's a life-changing event of financial independence. So we did have this exit last year. Home Depot bought a company called SRS in the very glamorous business of distributing residential roofing products. They don't make them, they don't put them on your house, they just distribute them. And we quadrupled or quintupled EBITDA over 6 years, which is our job, and we shared equity very broadly. So when Home Depot paid $18 billion for the company, which was one of the top 5 exits, I think, cash exits in private equity history, 9,000 of SRS's 11,000 employees shared in $3 billion of cash. And this is from the CEO to the store manager to the forklift driver to the accounts payable clerk, and life-changing financial independence where people could pay off their mortgages, send their kids to college, buy their parents a house, whatever it is. So we have story after story. Every year or so we have a new story like that, where hundreds, if not thousands, of people are in fact living the American dream. Many of them are immigrants. They may be military veterans. They may be they were incarcerated. And these are kind of blue-collar jobs where we give them a chance and make them stakeholders. And it's made a lot of money for us, for our investors, and for these people. Mr. Car Wash, 2-3 years ago, we had people making hundreds of thousands of millions of dollars washing cars. Again, we're not in the sexiest businesses. We're kind of in, businesses like this. We inspect fire prevention equipment. We put air conditioning in. We'll fix your car. We'll wash your car. But we do share ownership widely. And I think it's becoming more common in the industry. But many of our peers don't do it quite broad enough. And we have had such success with the broad equity ownership. And it's probably the most gratifying part of my job is when you have a situation like that and you say, hey, we see these video testimonials and we change lives, and the American dream is alive and well in private equity. So that's our story.
Robert, you've seen a lot of volatility over the last 25 years. Plenty of cycles, and today we're in maybe even a more dramatic change than occurred in the last 25 years. How do investors, besides giving you money, which is of course their first choice, how do they differentiate going forward here in software firms? Those that are going to be successful, those that are not, and how do you decide what kind of companies you want to invest in?
Most important thing, I think, is they give us more money to invest on their behalf. Enterprise software has proven to be both durable and resilient. The mission-critical nature of it, and when it is actually embedded deep within institutions, large institutions, medium-sized, small businesses, it continues to liberate a tremendous amount of productivity. Again, I stated the numbers of 625% ROI of existing companies that we have for their existing customers, and the Gen AI or AI enablement of that is accelerating that quite dramatically. But what we've seen in cycles, one of the cycles, I look at the great financial crisis where the government was bailing out the automobile industry, and we owned a number of assets, one of which I think on this screen was automobile parts. And in that period of time, we're actually able to grow revenues and grow EBITDA. Why? And Satya Nadella stated this in his earnings report earlier this week. It is because when there's no greater tool that gives you greater utility if you need to cut costs or to expand your reach than software. And the aspect of creating agentic software where you have agents and tools that are working alongside individuals to give them extensibility into the markets and the opportunities and give to them information, analysis, and in some cases activities, and completing activities for them should accelerate the pace of business, accelerate the pace of capturing that opportunity, in many cases accelerate the reduction of cost in servicing those customers. And so that dynamic not only exists in enterprise software companies, but is truly being accelerated in leveraging these new tools. The challenge is going to be he or she who embraces those tools most effectively first and fast. Because if you don't do that in this environment, then there will be occasions where newer companies, newer thought processes, and utilization will eliminate for the need for certain of those businesses to exist. The good news about the enterprise is often, if you did this well in the last 25 years or so, you have sovereignty and dominion over the workflows and the data sets, which enable you to deploy agents that are trusted, that know the environments, that have the ability to update the proper databases, have the right sort of permissioning activities, because you have the true intellectual property about how that business works, how that industry works, and you're not deploying in a random unsupervised agent into an environment. And so it is a paradigm that has to be not only well understood but defined, which is why we build the whole factory concept to do this well. You're going to hear others talk about, not on this panel, but others talk about deploying agents into environments in some agentic states that can update databases. I think it will be quite some time before there's a level of trust where you'll let them wander around and update wire transfer information unsupervised or not within a construct that gives people certainty. So I think that's the opportunity set that we're looking to embrace over the next many years, not only with existing companies, but ones we are now underwriting them, knowing that, okay, as you drive these new technologies and tools into that underwriting case, what does that business now look like? How do you run this at those rule of 70, rule of 80, and deliver agentic solutions that have the right sort of constructs that are safe, they are trusted, they are reliable, they are protected, because you actually have to protect these agents like individual users. All of those are, in essence, complex algorithms that must be understood, and with the right partnerships and focus and attention, we will be able to deliver, I think, the highest quality agentic solutions in the marketplace, and that's what we're seeking.
Thank you, Robert. Mark, obviously in the last few years, a great deal of capital has gone into private credit. And you've been one of the leading companies in this area. So what do you see the overall investment business looking like if private credit does become a larger percentage of the portfolios? And when I call around and talk to a number of people, it's significant how much additional capital has not yet been invested but committed to private credit. So what do you see the next year or two look like here?
So no doubt there have been a lot more entrants in private credit. Any market that's working, as we all know, will attract capital. But the market structure is pretty interesting. If you look at it, it's like a pyramid shape, again, like maybe many industries are. But we've always tried to operate, and the shape of this market, toward the large end of the market. And there, if you look, it's actually the same handful of companies that provided the capital 5 years ago. And so, we're all bigger. The big have gotten bigger. But it's actually a curious market in so much as I would proffer that it's somewhere, we might call it the sweet spot, between just specialized enough and just commoditized enough. Look, we like to think what we do is really value added, and I think we're very good at it. But there's other people that are good at it too. And frankly, we've got sort of enough of them in the market to meet the need, to your point about capital formation. To me, the maybe interesting output of this capital development and the emergence of private credit is, what does it mean for economic cycles? What does it mean for capital availability? Think about the evolving notion of like maturity walls. Back in 07, when we all went through the great financial crisis, maturity walls were a gigantic hurdle, and nobody quite knew, other than through liability management, how to cross them. But maturity walls, in the presence of a lot of money in the hands of long-dated private investors, look very different. If you think about a company in our portfolio, if we're lucky enough to have a company that's performing, we're happy to have it stay in the portfolio for 5 years, 10 years, 15 years, 20 years. So this notion of a maturity, it's probably the most important covenant you could imagine, right? Because we can say, well, we want to be paid back. But if the company's doing okay, we don't have any need. In fact, we prefer to keep our capital working. So I actually think the implication of this formation of a sizable pool of capital is going to change. It doesn't mean transform in an unimaginable way, but it's going to change the nature, and we can see it in the way restructurings have played out even over the last few years.
When you talk about size, Mark, what would be the median size of your investment? Where would that midpoint be? How many dollars are you putting into one loan today?
So diversification is decidedly our friend in credit, right? We're all about risk management, and the final risk is the thing no one can contemplate. And so for us, we prefer to keep our position sizes small. That again favors scale, because in aggregate in credit today, we manage by about $140 billion in assets. So actually the typical position is measured in hundreds of millions of dollars. The typical company, in fact, the average in our portfolio has $250 million in EBITDA. So they're really sizable enterprises that are linking in these private companies that, of course, Jonathan has pioneered for years, are linking in with the private debt ecosystem, and the whole system is becoming, a bit closed. So our typical hold is probably several hundred million. If it's a software business where we specialize and partner with folks like Robert, then actually we might hold $1 billion of that capital. But I will say concentration is no great quest for ours. We're quite happy to diversify our portfolio after all the work that goes into picking the credits we have.
So, Victor, you talked to us about your vertically integrated. We are now going to source the supply. We're going to bring it in the house. We're now going to manage it. We're going to pass it. Take us inside your firm for a short period of time. So we're all members of the Strategic Value Partners team now. And give us the process of how you look at a potential investment and how it plays through your vertical integration.
We can be quite choosy, quite focused, right? So we will make 15 investments, 20 investments a year of significance. There might be some big piece of real estate. It might be these controlled businesses, but we are very choosy. And I think for somebody like us, we are looking for industries which we really know. And after 25 years, consumer brands, business services, manufacturing, packaging, building materials, Jonathan, these are some of the places we built up knowledge. We have management teams. We have talked to advisors and consultants, right? We have it. And I think for us, we are not, so, when you're in the Strategic Value Partners team, we're not trying to buy a business which is declining, secular declines kind of forever, which we think we can restore and rescue. That's not us. We're not that brave. We are focused on really interesting businesses with large market share, a true reason to exist, which have been kind of undermanaged. So we bought a business called Hornblower through a distressed debt restructuring last year. The business itself, the Niagara Falls Ferry, the Statue of Liberty.
I've taken that ferry.
Yeah, no, it's, and by the way, they had expanded out into some other things which got them a little bit into trouble, but just great businesses. And we bought the largest parking garage operator in Europe with 1.5 million parking slots, right? So it's those kind of businesses, and when we look at it, the first thing is, hey, can we buy cheap? Buying cheap, like, can we create the stuff at 6 times, 7 times cash flow, not at 12 times, 15 times? The second part of it is, hey, is it undermanaged? It's not just kind of, hey, we bought it cheap at 60 cents, we're going to sell out of it at 80 cents. It's, yeah, sure, we bought it cheap. But is there, and by the way, in a lot of these businesses, the management teams are turning over every year, every 2 years, right, as the company gets into trouble. So you look at these businesses and you say, hey, operationally, there's a lot to kind of do with it, right? And it's that ilk of investment which we try and replicate again and again.
So as you approach these, you have to be in tune to the market then as to where you think you can buy. So are you letting the market determine first, whether you can invest or not. How many times do you identify a situation but you can't buy a substantial amount of the credit?
We are letting that opportunity come to us. So we bought a toll road in Texas through the debt, right? We are not in Austin, Texas, one of the fastest growing regions in the US. You're not going to be able to go buy, say, hey, I like toll roads, I'd like to buy them. There was $1.6 billion of debt, there was a maturity, it was defaulting. We bought the debt at 60 cents. You wait. You wait for the market to give you that opportunity, right? Because otherwise and that way you create it in a sort of a non-competitive way at a good price. Once you kind of have that investment, then the next part of the goal is, okay, what can I really do with it? And in this particular case, it was, hey, can I go out? And there's a lot of stuff I can foster in terms of development. By the way, Elon's Gigafactory is sited on our road. When we bought the road, the toll road, there was no plans for the Gigafactory, the Tesla Gigafactory, to be on it. By the way, I think we were luckier rather than good that time, okay? But I think for us, buying an asset like that in the right place and creating all the pieces of it which can make it grow, I think those are the things we're focused on.
So Ann, let's get down to opportunities for investors in this current environment. If you're going to deploy capital today, how would government investors build partnerships in this area? And so when you're visiting a client, the minute this panel ends, what are you going to tell them your focus and what do you think those opportunities are?
Well, it's interesting in a time like this where most people are concerned about deploying any capital and they're very concerned about the direction of the markets. I focus on, as I mentioned already, the fundamentals. And there are a number of areas that make a lot of sense. Historically, we're fixed income asset managers at Guggenheim. And believe it or not, it's really a reasonable time to be putting money to work and deploying capital in fixed income. On a yield basis, if we look back 25 years, we're in the upper percentile of yield and for high credit quality assets. So investment grade fixed income is a good value. I've mentioned other fundamental investment opportunities, and maybe to the conversation that Victor was having with regard to roads, infrastructure. There's a need for $5 trillion a year of infrastructure development globally, and I think it adds up to many tens of trillions of dollars over the next number of years, and we're nowhere near meeting that investment need. That's an area for governments to have a public-private partnership with private investors to be able to deploy that capital. And we particularly like infrastructure investment because it has steady cash flows, it is a stable business, and whether you're in power, digital, telecommunications, logistics, roads, there's a tremendous need for capital to be deployed, and it will be a consistent returning investment over the course of time. If we think back again to the 10-year history of the Treasury, 4.5%, where we are a little bit less than that right now, is historically the average. And investors can make money at a 4.5% Treasury rate, and companies can manage their businesses in that kind of rate environment as well. And so, again, looking past the noise to the signal, I think that there's an opportunity to deploy capital, eventually in real estate. Not necessarily every sector of real estate right now, but certainly real estate and other real assets and private credit. Broadly, these markets also really resounding for private credit and the opportunity to deploy capital there, because a lot of infrastructure, real estate, private credit, these are not traditionally liquid markets, but that's why it's very important to look for solid performing, transactions that will provide that consistency of capital return over the course of time.
So, Ann, with U.S. governments between, depending on the maturity, 4 1/4 and 4 3/4, let's say today, you've been a significant investor in investment grade credit at Guggenheim for a long time, managing insurance money and others. And many of the pension funds that were underwater, now at 100 or 150 basis points spread over that, can meet their actual assumption. Are you seeing different inquiries today from the investors than, let's say, 4 years ago when the 10-year was under 1% and the 30-year was at 128? What is the discussion today, and how are investors reacting?
Well, again, to the point that we are at a moment in history, as I say, for the last 25 years, where we're at the north of the 60th to 70th percentile of yields, and that's very attractive for investors. And for those that are matching liabilities against these assets, the opportunity set is there. I think what also in investment grade that's important, particularly in investment grade corporate credit, is there's been a slow uptrend in quality. So while investments that say have a BBB rating, or even a BB rating if you go below investment grade, they've been slowly actually increasing their credit quality while not really changing the rating. And so as a result, what you see is better leverage ratios relative to history, and better interest coverage ratios, again, relative to history. And so that's a positive trend in terms of the ability of these assets to perform over cycles. And as investors, I think that's a very strong positive. If we take the long view, which we must in the fixed income world, this is an opportune time to participate.
Jonathan, investors turning over their money now and investing with Leonard Green. It was 40 years ago that you came here to lead me out of the wilderness from that standpoint. We've seen a number of the other firms today where they've had a passage to younger people from that standpoint. Still the investors are heavily looking at you and John Donhockle as the leaders. How do you structure your management and your younger people? Are you going to tell them you're going to be there till 90? When do you see passing of the torch?
That's a tough question.
Well, I saved it to last, Jonathan.
Wow. Yeah. Well, we had our investor conference last week, and we replayed some of our old music videos that we made 10 or 15 years ago. We take music videos and we redub them with new lyrics, making fun of ourselves and our LPs. And one of them was a vampire video, and a picture of me and John were there, and it said, "Vampires live forever." That didn't go over very big. But look at, our job is to grow and mentor the next generation of talent. About 15 years ago, John and I made two very important decisions. We had to pivot the firm away from the consumer retail world, where our investments, we made the name of our firm, and that world was changing pretty fast. And then we had to pivot the firm away from the dependence on the two of us. So today we have 20 other partners and principals who are really principally responsible for bringing in the deals and then wheeling out the gray hairs or maybe the white hairs to give a little experience. But we have broad equity ownership on our own firm. We have 20 owners our firm. We have 60 carry participants. And over time, we've been very candid with our LPs that we've been through a transition. We had our founder, Leonard Green, who transitioned out after about a dozen years in the firm. And we've told our investors that our successors reside in our company. But I think it's also important that, look, when someone starts at Leonard Green, we tell them, we assume you're smart, we assume you're good at math and pretty good at calculations. We have to teach you a few things. We have to teach you sales skills because the younger generation sometimes just sits behind the terminal And Mike taught us 40 years ago, sales skills are paramount. So teach our younger people to be able to carry a room with whatever idea they're presenting. That's hard to do. And then in the end, we have to teach them judgment. Because in the end, all of us in the investment business, we're in the yes or no business. There's no maybes. And everyone's inclination to say, well, I kind of like it. I'd like it more if it was this price, or this didn't happen and that didn't. Well, that's not the business. You know, whenever we have great successes, we look back and we say, wasn't that easy? Well, in every investment committee meeting, there's always problems with every deal. And our job is to look through the problems and make the decision, yes or no. And for us even, you know, one of the things we have to teach our people, it's not in our world about price. Because our mission is to grow businesses to double, triple, quadruple, or quintuple these kind of boring businesses that we invest in. And if we do that, we'll make money no matter what. Some businesses say, I make it on the buy. We don't make it on the buy. We make it based on growing the business. So these are all the skills we have to teach our next generation. And, you know, we have a great group of 50-somethings and 40-somethings and 30-somethings. And our job and our legacy will be, can we pull it off, transitioning to the next generation? We're planning for it. We're talking about it. We're passing more and more responsibility. But ask me in 10 years, because we won't live forever.
Thank you. Robert, you've been focused on many, many issues, income inequality and others in your lifetime. AI that you spoke to us about today, revolutionizing your portfolios, your structures. What responsibility do leaders and investors have to ensure AI benefits are broadly shared, not with a small group, but a large group? And I know these are issues that are very important to you.
Yeah. And there are layers to this. I was at a conference last night of investors in a dinner, and we were talking about what it is that we need to impart to the next generation. Many of us at some point will have to transition our firms, our capabilities to next generation. But while we are here, I think we do have a responsibility to transition certain aspects of our business to a broader set of the communities that we care about. One of the things we do is we built curriculum, for instance, that we have now in artificial intelligence in our sports business, and it's now offered at Morehouse and Spelman. Part of our next extension of that is to offer to all the HBCUs and to offer to any college who has an interest in learning how to enable their students to embrace artificial intelligence as a way of creating value in specific industries. And so part of our responsibility is to distribute knowledge, distribute capabilities. In some cases, it's within our companies. Some cases, it's through the philanthropic work that we all have a chance to participate in. And I know, Mike, you and I work on various areas in health and prostate cancer research, et cetera. And artificial intelligence changes the dimension of how certain of these diseases will be cured and addressed and understood. And part of our mission is to do that well. There's an impact of this that is something that we have to think about from a policy perspective. There are about 1 billion knowledge workers on the planet who make up about $40 trillion in salary and spend and impact. All of those jobs are at risk at some degree, at some level, through artificial intelligence. You know, these knowledge workers are taking information, processing that information and putting it either back into a system or another human being, and that's what they do throughout the day. Agentic solutions increase the reliability, the speed, and the frequency of those interactions. And there are going to be some policy decisions that need to be made because many of these information and knowledge worker roles and jobs brought, in some cases, billions of people out of poverty. And so the real question is, you know, as it becomes more efficient, more capable, are we able to expand trade, expand productivity, expand GDP and as it relates to specific nations that improve the quality and condition of the human condition. And those are things that I think have to be thought through and understood. You know, we are fiduciaries. Our role is to deliver to our investors our highest quality work. In our case is bringing productivity and performance. You know, I looked at one in our case, you know, almost 90% of our value that we create comes from value creation in the businesses, not multiple arbitrage. And that's through that hard work that you have to teach and train and enable. And we'll continue along that dimension. But at some point, the productivity of what we do will impact some broader economic employment dynamics. And that's something that's going to have to be thought through and understood. And I'm sure there will be some policy decisions that are made, I call it a pay grades higher than mine, that will impact how the rest of the world embraces this technology and how that technology impacts their condition.
Robert, we look forward to seeing how you address that in the next decade.
Thank you, Mike.
Mark, I know you've built with your partners a company to last. But my guess is in any industry, over time there's winners and there's losers, and they differentiate themselves. How do you see Blue Owl differentiating itself versus some of the other people in the private client investing private credit business?
For Blue Owl, for us, I think it's really about being very true to a couple of core missions, or really, in a way, understanding our own DNA. You know, we're not all things to all people. We couldn't be, don't want to be. But we want to be really, really effective at delivering, as I said, the investment results that people count on us for, these lower risk, income-oriented, predictable, picks and shovels kinds of capital solutions on the one hand, and I think staying true to that and understanding that our business is about partnering with the incredible people on this stage and being able to offer a part of a capital solution, being able to work with investors, whether those are sovereign wealth funds or pension funds or something we've spent a decade working on, individual investors. It's about being able to be part of a portfolio solution that's going to meet their needs. So I think for us, it's keeping a very close eye on those two strands, which is the nature of the products that we produce, the nature of the investment result, most important thing we do, and the way we produce that by being a reliable partner to corporations around the world. And we twist those two together, I guess in the right helix, that's our DNA. So for us, I believe it's all about focus. And yes, we've been one of the fastest growing firms, and yes, we're a very large firm, but we're much, much more focused, I think, than most of our peers. And we ultimately bind all that together, and I know this will be a soft comment, but I think all that said, culture matters almost more than anything else in terms of creating durability of an organization. And certainly from the point of view of Doug Ostrover and myself, we probably spend as much time on that topic, which is the culture and character of the people in the organization, as we do on executing an individual investment.
So Mark has teed that up, Victor. Talk to us about the culture of Strategic Value Partners. How do you maintain it? How do you deal with it as you bring in more people and expand?
We're a firm in a much smaller way than Mark's firm. We are growing very quickly. We had 41 investment professionals 5 years ago. We have 108 today. And the way with 41 investment professionals, you have collegiality, transparency, flexibility, you move at speed. You take it up from 41 to 108, you have to run it differently. More process, more structure around how the IC works and exit councils work. And at the same time, to continue that flexibility, my God, my colleagues are there and they'll attest to this, more meetings for you to be able to communicate so everybody is on the same page, right? But the other part of the culture for us has been growing. Jonathan, I like the way you described it, growing a set of leaders inside the firm as we grow. For us, what that has meant is, for somebody like me, I will sit down one-on-one with 12 people every 2 weeks, and I'll spend 30 minutes with them, talking about not just deals, but how they grow, how the skills they have, they need to kind of sharpen up. So I think for us, we're a firm in that growth phase. We've had to build structure, we've had to build process, and at the same point in time, to continue to have that flexibility, right? We've had to put we put lots of meetings, right? weekly meetings, bi-weekly meetings in the process, so people are just kind of completely aligned working together.
Well, in the next hour here on May 5th, 2025, we're going to reflect on what we've learned, what common sense we've heard from uncommon investors. Thank you very much for joining us today.
Thank you, Mike.
Thank you.
Thank you.